Once an overhyped, overvalued company that fell from grace, Sprouts Farmers Market has certainly had a troubled past. However, this billion-dollar grocery store has more to it than meets the eye and may just bloom into a solid investment. Hey everybody, welcome back to Dollars and Cents, helping you make sense of making dollars. With its roots grounded in 1943, Sprouts started as an open-air produce stand and was, by all accounts, pretty unremarkable. First opened by Henry Boney, the Boney family soon took over the business, expanded, and then rebranded to the Boney Market in 1969. From then on, not much would happen with the Boney Market until 2002, when it would again rebrand into the now familiar Sprouts Farmers Market. Sprouts soon took off as its own green giant, rapidly expanding with the acquisition of Henry's Sun Harvest in 2011 and Sunflower Foods in 2012. Eventually, Sprouts grew into a multi-billion-dollar grocery giant, culminating in its 2013 IPO. However, problems would weed their way in, not with the Sprouts business itself, but the stock. The company IPO'd at a $5.5 billion market cap valuation, then shot up to $6.5 billion, and with a PE of over 60, this proved unsustainable, and those weeds would strangle the company enough to crash it, its share price falling to its lowest at down over 65% off of its all-time highs in just a couple of years. It's been a long time since Sprouts fell from grace, and at this point, I believe the market has drastically undervalued this company. But of course, we need to start with the financials to determine if Sprouts is even worth taking a look at, and spoiler, it is. First and foremost, let's look at revenue, and boy, what a story here. Back in 2015, the company's revenue was $3.59 billion, and now that number in 2020 stands at $6.47 billion. That's a crazy increase for what's essentially just a grocery store, yet it's also a little bit misleading, but we'll get into that later. Next up is shares outstanding, which is simply mind-blowing. In 2015, Sprouts had 153.1 million shares outstanding. Then in 2020, it has just 117.82 million shares outstanding, representing a 21% decrease in total shares outstanding in just 5 years. This is the same level of share buybacks as the company we looked at last week, Best Buy. After that, we have free cash flow. Starting in 2015, Sprouts had $108.8 million in free cash flow, but by 2020, this number had grown to $372 million, more than a 200% increase, and it's always great to see the bottom line increasing faster than the revenue. Moving on, we have current assets versus current liabilities, and Sprouts has $577 million in current assets, with its current liabilities totaling $490 million. Normally, I'd like to see a greater difference between these two, favoring current assets. Sprouts does have $256 million in cash though, so somewhat of a relief. Now we need to take the last 5 years of free cash flow and multiply it by 20 to get an expected market cap. The average over the last 5 years is $174 million, and this multiplied by 20 gives us an expected market cap of $3.48 billion, just slightly undervalued from a free cash flow standpoint. To end our look into the financials, let's lastly look at return on invested capital and dividends. Unfortunately, here Sprouts is a little lackluster with a low ROIC of 7.2%. Last year though, Sprouts put up an improving 13.75% ROIC, so it seems that the company is doing better, at least recently. Sprouts doesn't pay dividends, unfortunately, although honestly, I'm kind of fine with this because their buybacks are so good. I'm starting to realize that buybacks might just be better than dividends, at least for the time being. With the financials out of the way, let's look at why I believe that Sprouts might just be worth investing in. One of the reasons that may be leading to Sprouts' success is the surge in healthier eating trends in the US. According to Mintel, 57% of millennials say they only shop in the fresh sections of grocery stores as opposed to their non-millennial counterparts at just 30%. Companies like Whole Foods, Wegmans, and Sprouts have all tried capitalizing on this trend. While a relative newcomer to this trend, Sprouts came out swinging. Revenue since its IPO is up over 300% compared to many of its other grocery partners sitting at 40 to 50%. Now I really want to look at Sprouts' revenue growth just a little bit closer. In retail, like Sprouts, there are two types of revenue: revenue from store openings versus same-store sales growth. Revenue from store openings is the revenue growth that comes from the company opening up more stores, while same-store sales growth is the actual increase in revenue from existing stores. With Sprouts' 17% year-over-year increase in revenue, only 3.7% of that was same-store sales growth. This means that Sprouts' main method of revenue growth was opening opening stores. Right now, that may not be such a bad thing, but it could be in a few years as the company reaches more penetration in the US market. But the company has been able to grow same-store sales for 54 consecutive quarters, and even faster than some grocers like Kroger's. Another tailwind working in Sprout's favor is the push for ESG, or ethical, sustainable, and corporate governance investing. It's like a sort of social credit score, looking at intangibles like sustainable products, ethical treatment of employees, and a company's societal impact. In recent years, more investors demand companies place a higher importance on ESG. You can see this with entire hedge funds dedicated to investing solely in companies that follow a strict ESG policy. Sprouts appears to place a high importance on ESG too. In its investor presentation, Sprouts made it a priority to reduce its environmental impact by reducing waste and donating otherwise thrown out food, something that companies don't often do. Plus, in its latest earnings call, Sprouts mentioned its new focus on organically grown produce, opening more distribution centers closer to stores and the farms they source from. On top of all of this, Sprouts has big plans for rapid expansion. In 2014, Sprouts had around 160 stores, but increased that number to 340 stores by 2021. And by 2025, the company plans to open up another 300 to 400 stores. Assuming this plan goes well, I expect both a dramatic increase in revenue and both share buybacks. Potentially even a dividend too. Yes, there's a lot of good things going for Sprouts right now, but there are a few things that are going against the company. One of which is that Sprouts is just a grocery store. Generally, grocery stores have razor-thin margins and absolutely no pricing power. If inflation gets even worse, Sprouts could feel that compression on its already small net margin of 4.4%. Yet another problem Sprouts faces is its dwindling uniqueness. Currently, the company stands separate from its competitors in that it has a heavy focus on organic produce and a small store shopping experience. Whole Foods and Trader Joe's are both inching into that scene, and eventually more will enter the market, copying the same focus. The last significant headwind facing Sprouts, I believe, is the rise of online grocery shopping. With big companies like Walmart and Amazon now offering grocery deliveries straight to your home, not as many people are leaving their house to go grocery shopping. Sprouts has managed to keep up with this move to online grocery shopping though. It saw a large increase in online sales over the last few years, most notably last year in 2020. Obviously. Despite the headwinds that would trample on both its potential future growth, I believe that Sprouts is an overlooked, undervalued, and hidden flower, blooming under the overgrowth and weeds. I also believe it to be underpriced from both a growth and share buyback standpoint, given that I think that the shares could be worth anywhere from $65 to $75 over the next 10 years. Given its rapid expansion, focus on ESG, and benefits from trends in healthier shopping, Sprouts really could stand to become a solid investment. Yet, like anything, you should always do more research before investing in any company, even Sprouts. For me though, I'll wait until the share price drops just a little bit lower and then hold, assuming that Sprouts stays the course. If you enjoyed this video on Sprouts Farmers Market, be sure to leave your opinions in the comments below, and until then, I will see all of you in the next episode of Dollars and Cents.